Hello and welcome to Macros with Mythili, the 18-hour show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. This week, we're going to take a hard look at a development that many seem to have dismissed as a non-event, the March 15-16 meeting of the US Federal Open Markets Committee, FOMC. But was it really a non-event? Sure, the Fed did not hike interest rates, but does the mere absence of rate action by the US Federal Reserve make it a non-event? Or does everything that the Fed do or not do or say have implications not only for the US economy but also for the rest of the world, including countries like India? We're going to try and read between the lines of the statement released by the Fed and pass the comments of the Fed chairman Janet Yellen at her post-meeting press conference with two experts who over the years have perfected the art of explaining the gobbledygook that often passes for central bank communications. I have with me Sajjid Chinoy, Chief India Economist and Executive Director J.P. Morgan, and Ananth Narayan, Managing Director, Regional Head of Financial Markets Asia at Standard Chartered. Welcome to the show, Sajjid, and Ananth as well. Let me start by asking you for an initial take on the Fed statement. Dovish, hawkish, bland? Take your pick. How would you like to describe the Fed statement at the conclusion of the FOMC meet? Sajjid?
Well, I think it was unambiguously dovish, and the reason one says that is because if you look at the economic forecast of the Fed today, our growth, inflation, unemployment, and where they expect these variables to evolve over the next year or two, it's almost identical to what the Fed had forecast last December. Yet last December, they had forecasted the median forecast, or the dot, so to speak, was of 4 rate hikes in 2016, and now at best we can expect 2 in the second half of the year. So faced with the same economic outlook, if one's monetary policy stance is more accommodative like it is now, you can only take away from that the Fed's more dovish. And I think what you're seeing here very briefly is this tension that the global economy has found itself in over the last year or two, where it's clearly bipolar. You've got some growth momentum in the G3, in the US for sure, the Euro area, Japan with a lot of monetary support, and you've got emerging markets that have been struggling for the most part in the last couple of years, both because there's a huge debt overhang and you've got a slowdown in China. And I think what you're seeing in the Fed is which of these forces will overwhelm the other. Will G3 growth pull up emerging markets, and will the recent increases in core inflation in the US sustain, or will you find that the slowdown in EMs and the impact of China will exhibit such large disinflationary forces that US inflation will not rise to any worrisome levels? I think the Chairwoman Yellen has very much bet on the latter. She doesn't believe that any increase in inflation in the last few months is sustainable, and she worries about global growth development. So I think I'll conclude by saying it's a dovish reaction function which has been largely influenced by a lot of renewed worries on global economic and financial development.
Okay, so let me ask Ananth. Ananth, Sajjid says that it's basically a dovish stance that the Fed has taken. But would you agree with that? Just your initial comment.
I do agree with that, Mythili. I think this is a dovish comment. The reality is that if you were to look at just the US economy by itself, they went into this extraordinary mode of having 0% Fed funds rate sometime in 2008 end, right? And since then, if you look at just the US market, things have developed quite a bit. S&P saw a low of about 700 sometime in early 2009. It's now 3 times that level. Case-Shiller index for property prices have gone up by 30-40% since the lows in 2009-2010. Unemployment, which was at 10% in the US, in 2009 endish, is now below 5%. Even the underemployment, which saw a peak of 16-17%, is now below 10%. Now, when you had that extraordinary situation of huge accommodation from the Federal Reserve, rates coming down to 0, it was the US economy was a patient sitting in the ICU. So the medicine that the Fed was kind of delivering was along those lines, or to a patient in the ICU. Now, clearly at the moment, the US economy is nowhere in that situation. Things are looking a lot better. Nobody is suggesting that things are back to the normal and things are hunky-dory, but they're definitely not the symptoms of a patient who needs to be on a ventilator. Now, given that situation, it's kind of, I guess, unnerving at the moment that you still have central bank policy which is so accommodative in the Fed and globally, right? Now, if you have S&P at close to all-time high levels, if you have unemployment at levels which are better than the average, does it really warrant a Fed funds rate at 0.25%? one would think it needs to be a lot higher than that. The problem though is, and exactly as Sajjid mentioned, the reality though is you've got a world which is mixed. While the US itself is looking a lot better, you have concerns about what's happening in China. You still have very high unemployment in Europe. You still have question marks in BOJ. So all of this put together means that you have this mix of hot and cold in the globe. What we are hoping is that all this policy accommodation and Federal Reserve and central bank pumping of liquidity can eventually be replaced by some modicum of actual genuine consumption and investment flows from the private sector. Now, unfortunately, that doesn't seem to be happening in a hurry, but one continues to hope that that will eventually happen, allowing banks and central banks to kind of reduce the amount of accommodation in the system.
Absolutely. So we're living on hope, and there's always hot and cold as far as the world economy and macroeconomics is concerned. But Sajjid, regardless of the reasons for the Fed action, and we'll discuss more on that later in the show, but what is the impact on India? Does it open up more policy space for us, give us a little breathing time, or does it really increase the risk of short-term flows, which are not very good for India? Look at what's happened to the rupee. Look at what happened to our bond yields. Not very good for us, either medium-term or long-term. So is it a plus for us, or is it a minus for us that the Fed opted to hold its horses? Sajjid?
Well, it's very much a mixed bag here, right? So prima facie, a more dovish Fed will allow all emerging markets, India is no exception, to be able to respond to domestic growth and inflation dynamics. It would, all else being equal, give the RBI more space to cut rates without having to worry what's going to happen to the exchange rate and being too asynchronous from the Fed cycle. But if you just step back and look at the more kind of general equilibrium argument here, to the extent that you've got this large risk on rally that may sustain for a while, what that could do is just push up commodity prices. We've already seen elements of that the last 48 hours. So to the extent that commodity prices are driven both by economic fundamentals and what's happening in China, but also to a large extent by the financialization and that stance of monetary policy, the more dovish the Fed is, the more balance sheet expansion the ECB does, the more negative interest rates BOJ follows, all that pushes up commodity prices, and that in a way adds to inflation risks in India. Now one can argue that that will also be accompanied by exchange rate appreciation, which will offset some of the commodity price increase. But you're seeing that in this environment, central banks are going to be more interventionist. They don't want their exchange rate to appreciate unduly, because then that makes their trade weighted exchange rate more uncompetitive. So you get this asymmetry where central banks, and I think the RBI will be no exception, will intervene more aggressively to prevent exchange rate appreciation, but you still get the commodity price increase, and net what that means is inflation risks at the margin may go up if this goes on for a prolonged period of time. I'll make one final point. I think we run the risk here of getting stuck in a bad equilibrium. One of the reasons I think that the Fed will not talk about, but which is very clear, is they worry about dollar strength. And the fact is, the more the ECB signals a desire to ease, the more the BOJ is going to ease, the less inclined the Fed will be to tighten, because that will just exacerbate dollar strength and have a negative feedback loop to the US economy. So absent global monetary coordination, this could go on for a while, and what that does is create the risk later on that the Fed's behind the curve, then you might see some more aggressive rate hikes, and that clearly is not good for emerging markets. So there are multiple forces here at play that policymakers and emerging markets will keep a very close eye on.
Ananth, Sajjid talked about monetary policy coordination globally, but is that really feasible at all? And he also spoke of commodity inflation, but it's not just commodity prices. What about stock markets? We've seen stock markets all over the world rally without any reference whatsoever to the fundamentals. So for countries like India, a Fed which is unduly dovish and for longer than warranted, is that really good news at all for us, Ananth?
Mythili, the way I put it is as follows, right? I guess we all have this backdrop of what happened in May 2013 when Bernanke kind of launched this Fed taper tantrum, and we saw all emerging markets, particularly India as well, in June and July of that year, completely roiled, the currency lost, the stock markets were sold off, bond outflows happened. So we have that in the back of our mind, and every time we think of a Fed rate hike, we kind of are worried that that might return repeat itself, and we might see outflows from emerging markets. Now, let's face the facts. We are where we are. The reality is the global markets have been sustained by some extraordinary accommodation from BOJ, from ECB, from the Fed, from practically every central bank in the world. Today, we have an extraordinary situation where more than 75% of global sovereign yields are below 2%. It's a situation not seen ever in history. Now, when you have a situation like this and so much of money pumped in the system, clearly some of that money goes into financial assets, which explains why stock markets globally, asset classes, all sorts of asset classes, real estate, commodities, all of them globally are being sustained by this liquidity phenomenon. Now, the reality is we don't like it. It doesn't sound real. It sounds more like a bubble, and the reality is we are all worried that at some stage this bubble might burst. What we are hoping for is that given there seems to be some space in the US, for instance, amongst the household and the corporates in the US who are sitting on some tons of cash levels at the moment and ability to spend, hopefully some amount of growth comes from there, and that can replace some of the monetary kind of accommodation that we are seeing globally. So what we are hoping for is we have this cold places in China, in Japan, in Europe. We've got some sense of maybe some warmth coming or potential for warmth coming from the US. Hopefully some growth comes from there, some consumption comes from there, and that steps in to take away some of the hot money and replace it with actual investment flows and trade flows. It's a wish. I guess the real risk is if you actually see, for instance, a commodity price inflation without underlying growth coming in, that could really put all the central banks in a fix and policymakers in a fix, where you might have to withdraw accommodation without underlying growth coming in just because you've got a bubble bursting somewhere. That's the real risk. If you have the benign situation of some underlying growth coming in from somewhere, and frankly the US is showing some signs of that, that might just allow for an easing of the situation without too much of turmoil in emerging markets. That's the hope that we really have.
Okay, actually a case of hope riding over experience, because I thought, Ananth, central banks are already in a fix. How much worse of a fix can they really get? But I'm afraid on that note, it's time for us to slip into a very short break, but please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're trying to make sense of the Fed's statement after its recent meeting with Ananth and Sajjid. Sajjid, we talked about how difficult it is really to understand the equations that go into the Fed's mind, Janet Yellen's mind. And if you see, in September, the Fed held its horses, citing global concerns. In December, it hiked rates, even though global scenario was not really that different. And now in March, it has again opted to maintain status quo. Though as per the chairman's own admission at the press conference, the committee's baseline expectations for economic activity and labor market and inflation have not really changed that much since December. So does this suggest that for all the sophistication that central banks say they bring to their decision-making process, it's a bit like the witch doctor's brew? One doesn't really quite know what goes into it. This is not to condemn monetary authorities, but simply to accept that it's almost impossible to really reduce a subject that involves human irrationality to equations and regressions. And that's what keeps people like us in business, perhaps. But there's really no science at all. And that's what makes it so difficult, really, for other countries' monetary authorities to frame policy. Sajjid?
No, Mythili, you bring up a good point. I think, the challenge that the Fed has found itself on in the last year or so has been how do you balance, consistency of approach, which other central banks and market participants can understand, with being flexible to global developments. And I think it's a fine balance. But, maybe some people feel that there's been too much focus on meeting to meeting on what the developments have been globally, and too much focus on being flexible, and that may have, at some level undermined some of the consistency, because as you pointed out, none of the outlook of the Fed has changed till December, and therefore it's hard to understand why you've now moved from a situation of 4 rate hikes to 2 rate hikes, especially when one would argue that the Chinese economy, which clearly was the elephant in the room at the end of last year, it seems to be stabilizing. It seems like policymakers have got a grip on the situation. Fiscal policy this year is going to be more supportive. Risks of a hard landing have diminished. So if you put that together with the fact that the labor market continues to run hot, and you've got core inflation, which is now running at 2.3%. In fact, the Fed's favorite measure of inflation, core PCE, is now almost at 1.7%, far higher than when the Fed has started to raise rates in previous cycles. all of that would have suggested that, for continuity, for predictability, for consistency, we should have seen perhaps another rate hike already by now. So it is a bit puzzling. I think what the Fed will argue is that there is an asymmetry to monetary policy, that what you don't want to do is raise rates now and be forced to cut later in the year. That will send a terrible signal. What you can do is catch up. What some market participants will counter that and say, well, you don't want to be too far behind the curve, because the worst thing that can happen, both for the prospect of a US recession as well as for a lot of global uncertainty, is for the Fed to find itself way behind the curve later this year. The labor market's running very hot, inflation pressures have begun to rise, and then you're playing catch up, because that can be very disruptive to global financial flows and what emerging markets will contend with.
Yeah, absolutely. I think we're trying to play catch up. We're trying to understand what the Fed says when apparently it doesn't seem to make sense. But Ananth, I'm not sure whether you recall, the former Fed chairman Alan Greenspan, he was extraordinarily proud of how he always kept markets guessing. Mumbling with great incoherence was how he put it. In fact, in a paper presented at an annual conference for the Bank of International Settlements in 2008, Alan Blinder of Princeton University had said that central bank communications are rarely known for their sparkling prose or even for their clarity. Have things improved since? Doesn't anybody know what drives the Fed? And must that forever remain a black box, which again, as Sajjid said, makes life very difficult for people like us who are trying to frame policy, because the Fed has become de facto the central bank for the whole world.
Mythili, I have a slightly cynical view on this one. The reality is, the reason why central bank communication ought not to be completely clear is because even the central banks cannot be sure about what's really going to happen. A case in point is, consistently the Fed has been, the dots of the Fed have been indicating far more rate hikes than the market actually has priced in. Last year, when the Fed dots indicated 4 rate hikes through the course of 2016, the market consistently was saying maybe 2, not really 4. Right now, the dots have the median dots have come to 2, and the market is saying maybe 1, not 2, right? So clearly the market has been correct in this particular instance, and Fed is correcting itself from what it thought it was. Also, not just the Fed, you look at the brightest minds in the research world, the last 6 years, 2010 onwards, the consensus opinion of established good research folks has consistently overestimated global growth. The reality is, Mythili, we simply don't know what we don't know. Right now, things look like, risk seems to be coming on. We've got a much better market. We've got emerging markets rallying. But can we really be sure that there is no time bomb ticking away anywhere in some corner of the world that we haven't heard of before? Earlier it was Greece and pigs and so on and so forth. Then it became China. What's next? Even in China itself, the reality is vulnerabilities still seem to be there, even though the economy seems to be stabilizing. At close to 3 times GDP of bank debt, without sustainable growth coming through to service those banking loans, is the economy really in a shape where it can continue to grow the way it ought to grow? These are questions and imponderables which, frankly, we don't have the answers to. To that extent, the reality is nobody, including the Fed with its brightest minds and the huge amount of data available, can really be sure about what's going to develop over time, which is one of the reasons why I guess monetary policy has to be asymmetric. While indications, including PCE and including core inflation and CPI, indicate, and unemployment and growth, all of it, indicate that Fed ought to be a lot more aggressive in its monetary policy, removal of accommodation. Reality is it cannot afford that because it doesn't know what's going to hit it from the rest of the world. The good news, though, is while we have uncertainties everywhere, we also have pockets which seem to have some capacity to spend. Hopefully they prevail.
That's a very damning admission from Ananth, and actually it's true. So he's put it very bluntly. All of us like to pretend we know more than what we do. But even despite the fact that there are so many imponderables, does the Fed, like many central banks today, seem more unduly concerned about financial markets rather than the real economy? They always seem to see how is the financial market going to react. And is that really one of the reasons for the underlying cause of all our problems? Because if you remember, starting with Alan Greenspan, the famous Greenspan put, which saw the former US Fed chairman rally to support the market every time it seemed to go down, and today we seem to be paying the price for that. So are central banks everywhere concerned with financial markets when actually they should be concerned with real lives?
I completely agree with you, Mythili, because there's a chicken and egg problem here. There is a lot of uncertainty in financial markets, but guess what one of the reasons of the uncertainty is? It's the Fed's reaction function. So in a way, the more confusing the reaction function becomes, and the more it changes meeting to meeting, there's heightened uncertainty in financial markets, and then that's cited by the Fed as changing its reaction function. So this is the vicious cycle. You know, there's a Heisenberg uncertainty principle in physics where the very act of observing something changes its outcome. So we need to be careful that the Fed doesn't get caught in that. You know, I agree with Ananth to the point that there are lots of vulnerabilities around the world and central banks need to tread carefully. But I think what was confusing or surprising about this meeting is, if in fact the outlook of the Fed had changed meaningfully from December, it should have shown up in the economic forecasts. The economic forecasts have not changed at all since December. Whether it's growth, I mean, they've changed so modestly that it's indistinguishable. Growth outlook is the same, the unemployment rate's the same, inflation rate's the same. So if your economic outlook hasn't changed, but your reaction function has changed so meaningfully as to go from 4 rate hikes to 2 rate hikes, that's a bit confusing. I think that's the part that, you know, other central bankers or market participants may find a little bit confusing. We, of course, have to be flexible to global developments. Every central bank has to be it. But there's a balance between being flexible and also providing some kind of monetary anchor to the rest of the world that the rest of the world can use to create its own sets of policies. I think that's really why the latest dovish statement has come as a bit of a surprise.
Ananth, Sajjid brought physics into the equation, and that's what I think is the basis of the problem, because we have too many physicists and engineers straying into central banking and trying to put everything into an equation. But even assuming that it can be done, and that's what it seems to suggest, because at the press conference, Yellen talked about a neutral nominal Fed funds rate. Define at that rate at which, you know, the economy would neither be expansionary nor in contractionary mode. My question to you is, can we think in terms of a neutral rate as far as the Indian situation is concerned, a neutral repo rate? And if that is so, what would that neutral repo rate be?
Wow, Mythili, you're starting a completely new debate all on its own. This can, you know, go on for the next half an hour as well. Look, India is in a kind of a different situation at the moment. Clearly, while we are not immune to what's happening globally, and we will have to react to what the Fed does and what China does and so on and so forth, we also have a unique situation where things are looking okay. There is reforms happening at the center. There is spending happening from the government on infrastructure on the basis of lower commodity and oil prices. There are good things happening. At the same time, we also have issues of consumption still being low, investment still being relatively low, and the fact that we have a very stressed banking sector which requires a lot of relief, both on corporate balance sheets and on banking balance sheets. To me personally, that indicates, forget about the repo rate, and, you know, that we can argue about. Overall rates in the system need to come down. Normally, when you have a tough economic cycle, you know, treasuries tend to make up for that with lower rates and profits on the bank treasuries, plus cost of borrowings for the corporates come down, easing their burden as well. Now, to me, there is no doubt that, as I mentioned, you know, 80%, 75% of global sovereign yields are below 2%, and India is still in the 7.5, 7.75 range, which looks way too high to me. I think rates ought to be a lot lower. Having said that, we also have to be conscious of, you know, all possible risks, and you've got to be, you know, a lot more vigilant about what could happen. There is always monsoon, there's always CPI inflation possible, commodity price bounce up, etc., etc. Now, one of the other things about, you know, why rates need to be lower in India is the point you made about, you know, central banks kind of guiding the markets towards one direction by giving an indication of where they are. Now, one of the vulnerabilities I see in India is the level of unhedged foreign currency exposures we are building up. Because you have such a high interest rate in India, and because forwards are so high, exporters are hedging, importers are not hedging, people who take ECBs are not hedging, FIs who bring in money are not hedging. Now, when we saw the volatility in the rupee in the beginning of the year, when China kind of wobbled, it was because we had this overhang of unhedged positions, which are very, very nervous. You know, so things like interest rate actually impact vulnerabilities of this kind being built in the system as well. So to me, therefore, I think rates need to come down a lot lower than from where they are. They need to give relief to the system. And of course, you've got to overall keep in track what's happening to CPI, what's the possible future trajectory of commodity prices, monsoon, and so on and so forth. That's at least my two-bit take.
Sajjid, Ananth seems to suggest that rates are very high, but if you look at real rates, they don't seem too high at the moment, given that inflation is close to 5.5%. So a quick take on that, should we be looking at real rates or nominal rates, Sajjid?
No, I think real rates are where real rates will need to be to meet your inflation target. I think that's the bottom line. If you look at the Fed, if you cut through all the noise, ultimately they're an inflation targeter. They want to target inflation at 2%, and the Fed will do whatever it takes to US rates to hit that 2% target. Similarly, in India's case, the primary objective of monetary policy here is that we want to bring inflation down and keep it down to 5% at the end of this year, and then hopefully bring it down further to 4% next year. And more importantly, this is not just to hit it for 1 or 2 months. You want to keep it in this range of 4 to 6 across the business cycle. So I think, it's hard to talk about what the real rate should be in an abstract term. The real rate has to be whatever real rate it takes to keep inflation at 4 to 6, and that's a dynamic construct, because the real rate that will be needed to keep inflation at a certain level will depend on what potential growth is, what's happening to commodity prices, where we are in the business cycle, what happens to fiscal policy. There are a whole host of variables. I would not say real rates are unduly high, because as you said, inflation is still expected to average 5.5%. But given that that is the central focus of monetary policy in India and across most central banks, that will have to be the overriding objective of where real rates go. That yes, if inflation comes down, that will give the RBI that much more space to bring nominal rates down.
Yes, indeed, there are far too many imponderables. It's a tough time to be a central banker. But I'm afraid we've really run out of time over here, so I'll have to bring this discussion to an end. Thank you so much, Sajjid and Ananth, for giving us your take on the Fed statement and what it could possibly mean for India. The bottom line really is that regardless of what the Fed may say or do, the fact is that we have to strengthen our own fundamentals so that we become less vulnerable to external shocks. Globalization has its upsides and downsides, and you can't choose to have one without the other. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.